increases cycles, tech has outperformed. And so I think the sector had been beaten up maybe a little bit too much, Scott, and now we've seen some bond fishing come in. So I think the resiliency of the U.S. market is on clear display right now.
All right, my man Kramer's with us as well. Jim, welcome to Overtime. It's great to welcome you to the conversation, too. My question to you is, in fact, are we too laissez-faire about what's happening with Russia? Are we too laissez-faire about what's happening with interest rates? I see a 2-year today.
In terms of geopolitical risks, is ratcheting higher. At least there's some stabilizing there. You know, you get the news out of last night in terms of the U.S. is going to be providing more natural gas for the EU. You also have, you know, the Fed basically has been very hawkish all week with the myriad of speakers out there kind of talking about what their stance is and how they're going to battle inflation. And the markets have kind of taken that in step, and that's it's been interesting to see it. It's interesting also that on the close, if you notice, right where we stopped, right there at that 100-day moving average. From a technical level, I think that's important because if you go back to February, we kind of hit that level twice and before we started that pullback. So something I'm going to be paying attention to as the market opens up next week.
Alex, I want to ask you about rising oil prices. We obviously saw a big uptick in oil prices this week, but they were down yesterday and then today for a good chunk of the day. They were down 2%, and then we saw a turnaround up about 0.3%, so back below 113 a barrel. But anything particular behind that turnaround?
Well, I think in the near term, there's just a ton of unknowns in terms of, you know, where supply is going to be replaced as they attempt to wean themselves off of Russian oil in Europe, and of course the geopolitical tensions weighing on some of those relationships across the world. But I think it's in many cases better, unless you're directly involved in those markets, to look at it on a little bit longer term basis. Clearly this commodity has been moving alongside most of its other commodity peers in one particular direction. That's been one to the upside. So I'm trying not to get caught too much into the noisy choppiness of the back and forth, you know, volatility we've seen in this market. Generally, the trajectory is still higher. And what does that mean? That means Americans and those across the globe are paying more for their energy. It means factory workers, et cetera, are paying more to produce goods. And all of that ultimately means inflation ultimately for really everything that we buy. And so I think that adds so much as to why, next week when we look at the jobs report, how much wages are keeping pace is gonna be key.
We'll talk about that jobs report in just a minute. But first up, Joe, I know you said you're looking at the 100-day moving average, but next week is the end of the month, end of the quarter. Anything specific that we should keep in mind? What does that change the trading environment at all?
You know, I've heard a lot of talk about the rebalancing, right, with bonds down near, to the point that they are basically one of the worst starts to the year for bonds in history. The thought is that you're going to see a lot of the pension fund managers have to rebalance, right, to kind of get back in line with that 60-40 model or whatever model of choice that they are utilizing. And in doing so, what would they have to do? Well, they would have to sell equities and purchase bonds to kind of get those back in line. We've heard about that for a week. We haven't seen it nearly as much. I mean, look at the rates again today. I mean, another big move up in the 10-year yield, basically 247 or 248 and change. And you haven't seen it yet. Could it happen next week? It could. And if that is the case, you'd start to kind of see that rotation out of equities a little bit into fixed income. Now, I think from my perspective, when I look at where the S&P is, a nice bounce back that we've had this week and really now for a couple of weeks, heading into these levels, boy, you've seen the VIX ratchet down to around 21. We're back at a level where it might make some sense to start maybe adding some of those hedges if you believe that story will play out, where you will start to see a little bit of that rebalancing, where you will start to see a little bit of that overhang at some of these technical levels for the equities markets. There's no reason why you can't maybe start selling some of these rips, buying into some of that protection on the downside should we start to head back down. I'm not sure that we're completely in the clear yet. You know, a couple of things that I'm really kind of watching is, you know, these sentiment numbers have just been brutal. The University of Michigan consumer sentiment, and then next week we'll get consumer confidence. And what I think is really important, and Alex kind of talked about this in terms of, all right, well, at what point does inflation kind of really hit the wallets of the consumer? You know, when we look at one of the numbers that came out today, and that really is the future expectations, but versus the current conditions, and we'll get an even better gauge on that next week when the Conference Board has the consumer Senate or consumer confidence number. When you see spreads as wide as they are right now, that tends to be kind of a leading indicator into recessions, because basically what that says is that consumers are looking forward, and what they're looking forward when they see that, they're not very comfortable with what they're seeing. A lot of that's inflation driven. I think the majority of that is inflation driven, and this thought, right, that are their wages going to keep up with the increasing prices of goods? I mean, look, West Texas oil, WTI, is up 48%. At some point, that's going to start snapping back at consumers, and with consumers representing 70% of GDP, that's a big chunk of the economy that it's going to have a little bit of difficulty continuing at their same level of purchasing.
Alex, Joe makes a good point, because the strongest really parts of this economy have been the consumer, 2/3, but also the housing market, which we're starting to see some decline in sales because of mortgage rates. And then we'll, of course, get, as you made reference to, the jobs report next week. So I guess how important is it that we continue to see a strong labor market given all the other headwinds? And our producer, Patrick, pointed out that it's on April Fool's Day that it's released. So are we in store for an April Fool's Day joke? I hope not.
Well, I'll start with the jobs report. Obviously, it's a week away, so we'll see how expectations change throughout the week and what we'll be focused on. But what I will say is just taking the Fed at their word, and what their expectations are. And we talked about this earlier this morning as well, Caroline, the expectation is for the job market to remain pretty solid going out several years now. Their focus is now on prices. So we're going to get a huge look into where hiring's taking place. Is job growth still taking place? But from the Fed's perspective, from a monetary policy perspective, we're essentially at full employment, and the focus is now on the prices of the goods here in this country. And so from my perspective, I think that the wage component of this is going to be most important. Is real wages right now are underwater. So we're going to see if that can maybe shore up a little bit, as that could help some of that sentiment data that Joe was talking about. And as we go into here, you talked about the consumer, and you talked about the housing market. I never had a chance to check the accuracy of this, but I heard a statement in the last week that in last year, the average person made more on their home equity in terms of how much it appreciated than they did in their salary. If that's true, or even if it's not, and just a statement that someone's making as a joke, it shows just how important home prices and asset prices as a whole are to the everyday American nowadays, and so much of our system is built on the consumption. If there's worries in terms of that asset portfolio, including homes depreciating, all the while prices for goods that we're buying are going up, that's not going to necessarily help that sentiment. We're probably going to plow back on our spending, and then it almost becomes a self-fulfilling prophecy, as Joe talks about, in terms of recessionary activity.
And for those of us who don't own homes, it feels even harder in this environment, but we have to leave it there. Alex, Joe, thanks so much for joining us, and have a great weekend. We won't be seeing you again, Alex. Coming up, the president and CEO from Bank of California joins the show. Market on Close takes a quick time out, but we'll be right back, so stay tuned.
Let's walk through how to analyze a company's financials on Thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim, she wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade network.
Welcome back to Market on Close. I'm Caroline Woods. It's time now to bring in Jared Wolff, Chief Executive Officer and President of the Bank of California. Welcome to the show, Jared.
Thank you. Nice to be here.
I should note your company's ticker trades under the symbol BANC. But for those of us not in California or unfamiliar with the Bank of California, fill us in on your bank's focus and which sectors your clients operate in.
Thank you. We're a $9.5 billion relationship-focused business bank headquartered in Southern California. We serve all of California. We're a tech-forward bank that's serving businesses in the industries that power California, including real estate, commercial banking, professional services, media and entertainment, healthcare, and a lot of professional services.
You know, Jared, we talk a lot about banks standing to benefit from a more aggressive Fed in this rate hike cycle. That's from a stock perspective, but from a real world perspective, how are you positioned to benefit from this rate hike cycle that has just begun?
We're fortunate to be highly asset sensitive, which means that our loans are going to reprice faster than our deposits. As a result, we expect our net interest margin to expand. And as a result, our operating profits to expand significantly. We did that primarily by increasing our percentage of our non-interest bearing deposits as well as holding our loan yields during the last couple of years. 3 years ago, we had about 12% non-interest bearing deposits. Today, we have close to 40%. And that's going to give us a pretty good buffer as rates rise to have a certain percentage of our funding base, which has no expectation of participating in that rising rate environment.
The goal of the Fed is to combat inflation without sending this economy into a recession. So I guess how much of a concern is a slowdown or a recession in terms of for banks in general or for your bank specifically?
Well, the economy right now feels very resilient and it feels like it's holding up. The combination of the pandemic that we've all been experiencing and inflation concerns, I would say the confidence factor has definitely gone down recently in terms of fears about inflation, combined with the geopolitical events is certainly a cause for uncertainty. California, where we are, seems to be holding up very, very well. And there's, sectors like housing continue to be on fire, notwithstanding movements in rates and expectations that rates will continue to move. And that's due to a housing shortage that we have here in California. However, if rates rise too quickly, I think there is the possibility that there will be a slowdown in the economy. I think there is room to go, however, and that the Fed has room to move rates probably meaningfully before we hit that inflection point where it was too much for the economy to bear.
As we just talked about with our previous guests, though, consumer sentiment is waning because of these higher prices. I guess the question is, when or will it hit demand? So from your personal banking side, what are you seeing among your customers in terms of savings accounts, credit card debt, loan growth? Do you have any indication of how strong this consumer actually is?
So one thing that we look at is lines of credit and how they're being tapped. And currently, line of credit usage is down. For us, line of credit usage was at about 55% of of availability before the pandemic when the economy was strong. Right now, it's down in the mid-40s. And so people are not borrowing as much, and deposit levels are high, which means people are holding on to their cash. We haven't seen an outflow of that yet. I think if line of credit usage starts going down, then there would be some real concern. But right now, we expect it to rise.
Just curious, when do Fed rate hikes translate into higher savings account or interest on savings accounts? Because we saw, I feel like those are basically non-existent right now. Just curious how high the Fed needs to go to start earning more on savings accounts.
We get that question a lot, and how long does it take before a rise in rates generally shows up in your bank account, I think is what you're asking. And generally there's a lag. Rates move very quickly on loans, as you might imagine, and there's generally a pause on the deposit side, anywhere from 60 to 90 days. But in this environment where we are flush with liquidity, it might take even longer. Banks don't need deposits as much as they did in the past because all banks are running with high levels of liquidity and deposits. And therefore, part of the desire of banks to pay for deposits is based on their need to gather them. And to the extent that there's plenty of deposits in the market and banks are not yearning for them, I expect that the contribution of those rate increases back to depositors will probably be slow for a while. Sorry for the bad news.
That's disappointing. All right, so just in terms of your growth plans at Bank of California, I know you made an acquisition last year. You're investing in fintech. Talk to me about those plans. Are you in growth mode?
We are. I spent my first 2 years here kind of restructuring the company and helping us figure out our strategy for growth. And we're fortunate that for the last 18 months, we've been growing quite substantially. We were fortunate to close our acquisition of Pacific Mercantile Bancorp in the fourth quarter. That added a little over $1 billion in assets. We also got that deal integrated in the fourth quarter, which meant that we converted the systems and took out most of the costs. And so we're going to benefit from that growth this year. Our production levels and pipeline remain high, and we continue to see opportunities on the horizon for organic growth due to the economy holding up where we are. There is the opportunity to participate in growth through acquisitions as well, and we remain opportunistic on that front. Our team has a long track record of having done acquisitions, and so therefore it's something we feel confident in. And PacMerc, our acquisition last quarter, was an example of how we can execute quickly.
We'll leave it there. Jared Wolff, Chief Executive Officer and President of Bank of California. Thanks so much for joining the show.
Thank you very much for having me. Thank you.
Have a good weekend. Coming up, we've got the chart master, Rick Ducat, standing by. He'll give us the charts behind Lululemon and another company in the semiconductor space. Stay tuned. Market on close. We'll be back right after this.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back to Market on Close. The chart master, Rick Ducat, is here. Hi there, Rick. Happy Friday. Let's dive right in with some charts, starting with Micron. I was just checking because Tom White was here and gave the acronym MANGO for chip stocks. I was checking to see if M stood for Micron, but it's Marvell. But anyways, the semiconductor name reports earnings next Tuesday. That's Micron. Not to be confused with the other M in Mango. Walk us through the chart.
Yeah, looking at Micron, the first thing that strikes me is that the price action is in a broadening triangle type pattern where kind of like a channel, but the two lines are extending away from each other. So this is regarded as being one of the worst patterns to try to trade because your two target points are getting farther and farther apart. So it's just, for that reason, viewed as being one of the more difficult price actions to try to work with here. So looking at point A as well, price has gapped up recently, but it's been in a tighter, kind of more holding pattern during the past week and a half or so. We haven't really had a good move above the 252-day exponential moving average, that pink line there. And just above it is the 21-day exponential moving average in yellow. So we still have to break above those levels for this uptrend to continue. Looking at point B as well, if things do work out to the upside, that 63-day exponential moving average in orange, near about the 83 price level, seems like a good point to start looking for some resistance there during a time where price is below the moving averages. They serve as resistance, and vice versa for when they're above the moving averages serve as support. So looking finally at point C, this is the bottom of the recent range we've been in. It also represents the lows from January, near about 75.50. So if price starts to break beyond that point there, look for perhaps some support near the recent lows, near the 69 level.
I should note that ahead of its earnings next week, Wedbush came out with a pretty bullish note today saying that Micron is likely to meet or beat the company's guidance, as there are no signs the company's pushing discounted inventory towards the end of a quarter. So they have an outperform rating and a price target of 120 on the stock, so quite a bit higher than the 78 that it trades now. Didn't give it a boost today, down about 0.1%, but pretty bullish call there.
Yeah, and the price action is looking interesting as well. RSI is still kind of not really showing us much in particular yet, but you'd want to look for RSI to break above the 50 level as well as its previous highs in conjunction with price. That would lend further credence to any kind of move upward. It would help give more confirmation in the minds of the bulls there as well, Caroline.
Also with earnings on Tuesday after the bell is Lululemon. What's standing out in that chart, Rick?
Well, Lulu is another one here that is in a type of modified channel price action pattern. But this one, the lines are converging toward each other rather than away from each other. I suppose you could call this a very mild wedge pattern. And the falling wedge, where it's angling downward, is usually regarded as being more bullish. It really can go either way, though. You really want to avoid getting locked into the kind of thinking that these patterns will only move in one way in terms of the breakout. It just doesn't work that way. Looking at the more recent price action, we were in a downward trend for quite a while during the past year. Take a look at that blue line going across the highs from November, then down to January. We are sort of limping beyond it at this point. We're not seeing a strong breakout or really an uptrend resuming because we're still making lower highs and lower lows. Actually, no, the last low was only an intraday low. It wasn't actually a closing low. But still, we aren't making higher highs yet. So it's looking like we're a bit more range bound, I guess I would say, than in an actual uptrend, even though we are out of the downtrend here. So looking at point A, price closed above that yellow 21-day exponential moving average. It's also starting to break above that upper level of our wedge type pattern here. So that looks a bit encouraging for the bulls now that 21-day exponential moving average will become a support point for us going forward. It's roughly near about 311.50 or so. If price does continue moving upward, there were some clues in this RSI. Look down at point C. We did see a little bit of bullish divergence from the RSI. Price was making new lows, whereas the RSI was trending upward. So this can be a sign of bullish momentum starting to build up.
We'll also have to see what Lululemon has to say about higher prices. You know, with the stretched consumer, can they afford $100 sweatpants or probably even more given inflationary pressures? We'll leave it there. Rick Ducat, thanks so much for joining us. And thank you for joining us on Market on Close. Your first trade is up next. I'm Caroline Woods. Have a great weekend, and I'll see you next week.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
After the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
It's a 13-hour flight. That's not a weekend trip.
15 minutes.
Oh, wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. They're getting so smart.
Choose the app that fits your investing style.
Welcome to Your First Trade. I'm Scott Connor, a 30-year veteran trader, and it is Friday, March 25th. Now, on our show, we've got a lot to cover. We'll start off with Pat Mullally, chart master, and break down the charts, 3 charts of the major indices. And Pat's going to share his takeaways for what happened this week. Then I will go through the example trades that we put on in Your First Trade Monday through Thursday. We'll see how those did. And we also have a couple others that are expiring today, so we'll see how those finished up. And then finally, we'll join, actually not finally, but then we'll join John McNichol, and we're going to talk about an order type on the Thinkorswim platform. Now, this is called the OCO, one cancels other order type. If you're not familiar with it, you definitely want to see how this works. There's several ways this can be applied. And then finally, at the end, I will wrap up the market action on Wall Street today. All right, well, let's kick things off from the very top. And as I mentioned, we're going to bring in the chart master, Pat Mullally, and have him look at the 3 of the major U.S. indices to see what his takeaways are. Pat, thanks for joining us here to close down the week. It turned out to be an okay week. Pat, 3 out of the 4 indices were higher for the week. So I think that's good news overall. And I'd love to hear what you have to say by looking at the charts of 3 of the 4 major indices. Pat, what are your takeaways this week?
Well, it kind of goes back to where we started off, a week or so ago. Everything's kind of in lockstep between the 3 major industries, the S&P, the Nasdaq, and the Russell. But this week, we did slow down. We had a really strong lift off of those lows a week and a half ago, and we've run into some resistance. Whether it's a channel resistance, in the case of the Russell 2000 or with the S&P 500, just some resistance from the February, January highs, which is an important area if we take a look at this. So over the last, 6 months or so, we've been in this intermediate term downtrend, some kind of slowing in this intermediate term downtrend, kind of a sideways consolidation with some resistance, coming in at around 45.50. That's that red dash line. Now, the importance of what we're looking at here is we've watched the S&P climb back above that 200-day moving average. That's that blue dash line that we're above right now. That's an important area for a lot of institutions out there. We are running into some overhead supply, meaning that January, February highs just to the left of where price is right now. That's also the 100-day moving average. We don't show that on here, but we're in an important inflection point. And that's probably why we've seen a little bit of stalling over the last 4 days with some push, into the end of the day, a little bit of back and forth intraday, but we had that nice push going into the end of into the close of the day. So a little bit of stalling, but prices formed. This is an important distinction. A lot of technical traders out there looking at what they're calling a head and shoulders formation that some feel, Scott, has failed. But again, it's just rallied back. It's just testing the right shoulder of that head and shoulders pattern. So nothing's really failed yet. That's oftentimes happened. If it does fail here and we see price retest the recent lows, and if that fails and breaks down, we could see the subsequent measured move, technical measured move, drop all the way into about 35.50, which is going to be the September of 2020 highs.
All right, Pat, that's it for the S&PX. How about the Nasdaq, which was the only indice to finish down today? But what are you seeing on the charts with Nasdaq?
It did finish down today, but on a weekly basis, it outperformed relative to the S&P 500. So we've seen some nascent strength coming into the Nasdaq. A lot of that came from the semiconductors. As we watched a lot of Nvidia and a few of the others kind of take over. But again, that same thrust to the upside. This is what a lot of people are talking about, the thrust that we've had over the last 2 weeks to the upside, coming off of that support areas. Now we've got resistance coming in just above, right around 15.1. So we've got that 200-day moving average, the January, February highs as well. So we've got that price resistance, the overhead supply in there where we might see people sell again. But we've got some pretty good momentum climbing. Now that momentum is the RSI we're looking at down below on that lower part of the pane. When we're in a bearish bias, a bearish regime, this is where we look for the indicator to fail at the 60% area. That's why this as well as an inflection area. If it can get above 60%, above 65% on the RSI, and we see price climb up and above that 200-day moving average, Scott, we may see price continue to push higher, at least in the near term.
All right, Pat, now we just got a minute left. Let's take a look as well at the Russell 2000, an index that has been sort of lagging the others. What do you see on the RUT, Pat?
Yeah, right. So it lagged all last year, broke down along this year-long consolidation. But again, finally trying to move along with the Nasdaq and the S&P to the upside. You can see here it's just below that consolidation, so another inflection point above the 50-day moving average, that intermediate term moving average, which is important to a lot of institutions as well. Again, momentum slowing on the indicator, on the RSI indicator at the 60% area. So again, the inflection point is get back above and back into that channel, above that horizontal resistance to just above price right here. That's going to be right in around 2100. If it breaks back down, we're going to look at support to come in right around 1922. Now, it's already completed its measured move, the width of that channel that it built over the last year. So it dropped below there. It's completed that move. So maybe we're seeing some demand come back in here, Scott.
All right, well, Pat, thanks for giving us an end of the week breakdown on the major charts. I think long-term investors have to be feeling a lot better than they were 2 weeks ago, Pat. This is 2 weeks in a row. Markets have rallied. It seems like they're holding their gains. And like you pointed out, many are above the moving averages you pointed out. So let's see if we can hold on to those gains. Pat, have a great weekend. We look forward to having you back on your first trade. Take care. All right, now let's take a look at some of the example trades that we put on here throughout the week on your first trade. So follow me into the Thinkorswim platform. I'm going to go right to the Monitor tab. Let's take a look at some of those names. We kicked the week off looking at Apple, AAPL. Let me highlight that one first and take a look at what we did. Now, this expires still 20 days from now, so it has some time to run. But basically, we did a iron condor type strategy where we sold the 177.5, 175 call spread, and down below we sold the 150, 152 put spread. So we'd like to see the stock stay in between there. It has rallied. It's up to 174, but it's still within our goalpost, so to speak. What else did we look at? KB Homes. Now, this was based on an earnings play, and but it has 20 days to go. So we sold the 35, 34 put spread, and the stock is just kind of hanging around. It was a little bit heavy today, if you will, but it's been sort of hanging around that 34 level. Today closed 33.69. We've still got some time left to see if that stock doesn't come back up over the next few weeks. Then we looked at General Motors. Now this one, if you look at above, it's still working. We tried to sell the 40.5, 39.5 put spread for 20 cents. It looks like it's trading around 16, so it's still a little bit below our limit price. We'll let that one continue to work since it is a GTC, or good till cancel order. And finally, we looked at Boeing, symbol BA, and that's the one we looked at yesterday. And this was selling the 175, 172.5 put spread. We'd like to see the stock obviously go higher so that this put spread expires out of the money and worthless. Stock currently 188.82, so looking okay on this one. But again, this one has 20 days to go until expiration as well. So most of the trades we looked at were longer term. Now, we did have two expiring today. Let's go first to Disney, symbol DIS. And this is one we put on. You can always tell when you put a trade on by just clicking on the quantity. And you can see this is on March 15th. So it has been a while on this one. We sold the 122, 121 put spread, as you can see right here. And that expired today. We sold that for 39 cents. That's $39 minus any transaction fees. And it expired out of the money, so we realized that gain of $39. That worked out just great. And finally, LUV. This was a trade we did. Again, let's click on the quantity on the 18th of February. So this one had a long-term play. And we looked at buying the 47.50 call spread. So that was bullish. We wanted to see the stock go higher in that particular example trade. And sold the 41.43 put spread. Well, it ended up at 44, about 44.5. So the put spread expired worthless, right, which was fine. We sold that one, but it never got up above 47, so the call spread never really kicked in. And I think we paid about 30 cents for that one. So it looks like maybe about 60 cents. So it looks like it realized that loss of about $60 since the stock didn't make the move that was anticipated. But again, it was a fixed amount. We knew what it was going in. And that's what happened. Sometimes stocks don't always move, obviously, the way that a trader would hope. But this one just kind of languished between the call spread and the put spread and never really took off. We might look at another example trade on LUV, Southwest Airlines, maybe later next week. All right, well, that's going to do it for the takeaway on the markets this week and the example trades that we put on. But stay with us, because coming back is John McNichol, and we're going to talk about a very dynamic order type on Thinkorswim. It's called the OCO order. We're going to talk about what it is and how it can be used. We'll be back after this short break.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full options for volatility course and a whole lot more.
90 minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Welcome back to Your First Trade. I'm Scott Connor. Now let's turn our attention back to the Thinkorswim trading platform and talk about an order type called OCO. So we'll look at specific orders that can be triggered or canceled when certain conditions are met. And we'll talk about how that applies to the OCO. But specifically, we'll focus on those OCO order types and see how they can be combined with a stock purchase to include future potential exit points. And also, we'll talk about how an OCO order can be used to build a new position from scratch. Now, joining me to discuss how OCO order type orders work, and how they can be leveraged, we're going to be joined by Your First Trade contributor, John McNichol. John, thanks for joining us here again. And I always enjoy when we get to talk about some of these specific order types on the Thinkorswim platform. But before we get into the OCO order itself, there's a couple definitions I think we should touch on first. And one of those is the word trigger and how that applies to orders. John, maybe let's start there.
Sure. Well, obviously important for traders, have an idea or condition to get them in or out of a trade, Scott. And, the Thinkorswim does provide these tools to help us, plan that trade and trade that plan. So let's talk about a trigger. A trigger is a condition that, once met, causes an order to be activated or triggered. When triggered, the order becomes a working order in the marketplace and is going to be subject to execution.
Got it. So that word trigger, pretty important in terms of when the trigger gets met, that's what starts the order, makes it become a working order. Got it. All right. Now, there's another term we need to use here too, because we're going to refer to this one. That is stop orders. John, give us a quick primer on what we mean by stop orders.
Sure, Scott. So these orders that inherently have a trigger mechanism that is built into them. So a stop price is going to be the point at which the underlying order is entered or triggered. These can be set above or below current market prices.
Got it. All right. Now, let's take what we've covered so far and move to the OCO order type, John. So let's give us a breakdown. What do we mean by OCO orders?
So an OCO order is otherwise referred to as a one cancels other, OCO. The one cancels the other order, OCO, is simply a pair of orders that if one order is filled, then the other order is automatically canceled. Investors often use OCO orders to establish exit points for a new or an existing position. For example, assume a trader already owns 100 shares of stock, but wants to use a stop order to sell if the stock drops to a certain level. At the same time, the trader also wants to set a limit sell order at a higher price in case the stock reaches a targeted level. They may go ahead and get this accomplished by creating an OC order on an existing stock position, one for a price target and then one for a potential stop.
All right, John, here's what I'm going to do. I'm going to go into the Thinkorswim platform. Let's just give a quick example how we can add an OCO order to an existing position. So I think we had a portfolio that we created a couple of years ago, and I think BP is one of them that we had 100 shares. I mean, I'm going to go back to the monitor page and just open up that portfolio, and yes, BP is one that had 100 shares. All right, so assume we have 100 shares, and we'll go to the trade tab, and how do we create an OCO order? Well, again, what we want to do is set up an order that if we already own 100 shares and the stock gets to a certain level, then we'll sell it. And if the stock gets down to a certain level, John, where we're thinking, well, we'd like to at least maybe perhaps cut our losses there, we can use that stop order you talked about at a price below the current stock. So how do we do that? Well, first of all, what we'll do is we'll start off with a sell order of 100 shares. And what we're going to do is drop down here below where it says Advanced Order Type and click on this and then go to OCO. Now, what that will do is it will allow us to put the two orders in at the same time. So first of all, selling 100 shares, it's right now at 31.5. And John, I'm just going to pick another number. Let's say if it gets up to, how about $33 a share, a couple dollars higher than it is now. There's one. Then I'm going to click on the bid price again and create another order to sell 100 shares. And maybe I'm thinking, or the trader's thinking, if it gets to below 30, they want to go ahead and just sell that position, right? So again, this one I'm going to change and put in a price lower, as you can see, lower than the current stock price. And you might think, well, why would I do that? Well, again, it's not going to be a limit order. I'm going to change that to a stop order. Now, what a stop order is, that's where this trigger comes in. So the trigger now becomes $30 a share. If the stock gets down there, it triggers what? A market order. See where it says MKT here? That's a market order, right? Now, if I hit confirm and send on this, let's take a quick look at how this works. There's two orders. Order number one, sell the stock if it gets up to $33, the target price up above. And order number two, if it does go lower and hits 30, well, that should trigger an order to sell the stock as well as a market order. And if either one of those gets filled, one cancels the other. And you can see that right here. So it's an order description, OCO to close. Now, the only thing you might want to do on this one, John, I'm just going to change this to a GTC. To let this one work day in and day out until it's either filled or canceled, John. So that might be one way to look at that. All right, so there's one use of the OCO order for an existing position. John, what if someone has no position? How could they use an OCO order?
Well, as I mentioned earlier, plan a trade, trade a plan. If we have an idea of the condition that's going to get us into a trade, we probably should have an idea of what gets us out of the trade, so we can actually put these orders together, both the buy and sell orders at the same time. This is where a disciplined approach to trading comes into play. Here, a trader not only enters in order to buy the stock, but adds exit points along the way, basically above being able to create a targeted area, as well as having a stop level below. In the process, the trader is obligated to consider potential profit or loss levels before entering the original buy order. This order type is known as a first triggers OCO. One cancels other.
Got it. Okay, so now we're looking just a little bit different. So I'm going to go back to the Thinkorswim platform, and I'm putting in Microsoft as a symbol, John. We don't have a position in that. And I'm going to go to the ask price and click on the ask price. Now, of course, that's going to create an order to buy, right? But I don't want to do that this time. I'm going to go to the ask price and right-click this time, and then drop down to Buy Custom, and then with OCO bracket. Now, take a look at this one, John. This is interesting. Now, that was just one right-click to set this whole trade up. Of course, there's specifics that have to be changed, but it says buy 100 shares of stock, maybe at the current price here, and then it adds that OCO we were talking about. Then sell the stock if it gets to a target price above, and I'll go ahead and just make that something like $310, well above where it is now. Maybe that's the target price. And then if the stock were to go below, let's say 300, again, that same stop order would kick in to say, all right, if it gets down to 300, then go ahead and sell the stock at the market. Now, remember what a stop order is. It just means you're going to sell the shares at the market. It doesn't necessarily mean you're going to guarantee to get filled around that price. It just triggers the market order. Now, again, I'd probably make this GTC across the board, and then let's hit confirm and send. And basically, you can see here, just in a nutshell, buy 100 shares at the current price. That's what we're putting in here. Then sell 100 shares up at 310, or sell 100 shares, sell it back out for a loss to trigger a market order at $300 a share, and they're both OCO orders. So those second orders will only be triggered by the first order being filled, and then the other two will wait for either till it gets to 310 to sell or 300 which will trigger the market, the stop order. All right, John, we got to wrap it up there, but these are great applications of potential ways to use this OCO order type. All right, thanks, John. Have a great weekend. Look forward to seeing you again.
You too as well,
trade. All right, stay with us because I'll come back down and break down what happened on Wall Street today, what was behind the market movement, and we'll talk about some stocks on the move as well. We'll be back after this short break.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Welcome back to Your First Trade. I'm Scott Connor, and now time for the market wrap on this Friday, March 25th. Well, we talked a little bit about the market action today. All four indices, well, 3 out of the 4 finished in the green today. They started off higher, trended lower, tried to make a comeback, went down one more time, and then 3 out of the 4 did finish in the green. So actually it was kind of a win for the day. If you look at the major indices, you can see most of them on the day. Not big percentage moves, but we did see them move somewhere between maybe 1/10 or 0.5% on the day. So looked like a good move there. Now we'll also talk about some stock movers today and maybe some economic data that we talked about today. All right, now let's start off with what we saw not only outside of the indices themselves, but let's follow some of the commodities we've been keeping a close eye on. One of those is oil, for example. It was up again today, up around that 112, 113 level. So again, a little bit more fears of inflation pressures there. And RBOB, which is the gasoline future, that was up as well, over 1% on the day. So again, some of those inflation pressures that you and I see as consumers at the pump, still a concern. Now gold actually was down on the day, down about $5 or $6 to that 1956 level. So a little bit less bullishness in that commodity. Now, what about the 10-year yield? This was an important one. Obviously, we're watching that. The Fed's watching that. It is dominating their monetary policy going forward. It reached a new high that we haven't seen since April of 2019, 2.5% on the 10-year yield. Now, what else? We always follow the VIX to see what the market's telling us in terms of uncertainty or fear, and that actually hit a low that we haven't seen for a while. It broke below 21. The low was 20.82, and I believe it closed just a little bit higher, well, just right around, I think, that level. So good news in terms of fear coming out of the market. Now let's talk about some sectors that were on the move. Well, because oil was slightly higher today, we saw the energy sector showing some strength. Some of the big names that you follow, Exxon, Chevron, ConocoPhillips, Phillips 66, Kinder Morgan, all showing pretty good gains across the board. Some good strength with the energy sector. Now, where do we see some of the stocks that were not as strong today? Well, 9 out of 11 sectors were up, but 2 were down. So let's take a look at those weaker sections today, and one of those was in the consumer discretionary and information technology. So some of the names there that were a little bit weaker today include Microsoft. We had PayPal in that group. Also Lowe's, as was Home Depot, both down today, and a little bit of heaviness in the autos. Ford and GM were down as well. Ford down about 2% on the day. You can see we saw a little bit of weakness there. What about some individual stocks? Well, mRNA, Moderna, a name that's been in the news quite a bit, was down significantly today, almost 7.5%, about 13.75 points. And the news there is coming from the government potentially not funding another round, or what I think is the fourth round of vaccines. So again, that weighed a little bit on the company. And finally, Federal Express was also in the news today. They announced that they're going to be experimenting with electric carts to make deliveries in some major cities. They talked about New York specifically. So we'll see what that does to the stock. Stock was up about $1.44.5% on the day. Now, what about data points behind the market today? Well, we did get consumer sentiment. All right, now this is a Michigan number, and they survey 600 households across the country to get their outlook on economic conditions and how they feel going forward. That number was pretty much in line. I think we were looking for about a 59.7, came in about 59.4. So slightly disappointing, but really I don't think affected the market that much. Now, we did also have pending home sales today for the month of February. Now, these are existing homes, and that number did come in a little lower. We're looking for about a 1% increase month over month, but unfortunately it was down 4.1%. So the home sales continue to fall. That is a concern of the markets as well. But that's pretty much how the markets finished today, and there was obviously ongoing concern with the Fed this week. We heard from different Fed members speaking, and it sounds like the tone coming from all of them is more hawkish, and their expectations of inflation are that it might be more difficult to control than they originally thought. But all in all, good week for the indices. 3 out of the 4 were up on the week. That's 2 weeks in a row. We'll see if the markets can hang on going further. Well, that's going to do it for our market wrap today. Don't forget, we're back Monday at 4:30 Eastern Time to put together some more example trades and keep close tabs on the market. We look forward to seeing you then.
Once again, as the 10-year bond yield rises 5%, but the S&P looks like it's clocking in its second weekly gain. Here's a look at the numbers. The Dow is up 190 points at 34,898. And you can see the S&P 500 gaining 17 at 4537. The Nasdaq down 30 at 14,736. And the Russell gaining a quarter of 1%. Now to some of the biggest stock movers in the market. Shares of the biggest tech companies are reacting to new regulations from Europe. The EU announced the Digital Markets Act, which will aim to prevent large tech companies from abusing their dominant position in the market. Despite the news, Meta Platforms moving to the upside. Pot stocks have been beaten up, but are catching a bid today as House of Representatives prepares to vote on the Marijuana Opportunity, Reinvestment, and Expungement Act. The bill would remove cannabis from the list of federally controlled substances. The MJ ETF has fallen 50% in the last year. Take a look now at Bed Bath & Beyond, rallying after reaching a deal with Ryan Cohen's RC Ventures. The agreement will allow 3 new directors to be appointed to Bed Bath & Beyond's board, and Cohen's RC Ventures holds a nearly 10% stake in the home retailer. Shares of NEO are falling after its latest earnings report. The company did miss on earnings per share, a beat on sales. Chinese automaker issued first quarter sales guidance that was below previous guidance. Now that stock is down over 30% this year. Here's a look at the top futures products. We're looking at Bitcoin, dollar, gold. Here's a look at Bitcoin, 45,040, so that's gaining 875 today, up 2%. US dollar, 98.65, pulling back fractionally. The gold futures, you can see at 19.53 a troy ounce. That's also slightly lower by half of 1%. Crude oil down a half of 1% at 111.68. And you can see the VIX is down 1.5% at 23.90. Let's get some insights on the news shaping the markets. And for that, we welcome in Jeff Schulze, investment strategist, ClearBridge Investments. Glad to speak with you today. I was reading through your notes. I saw a lot of global picture news, right, from Russia to Europe. But I'd like to start with right here at home. So you're seeing the S&P now with its second weekly gain. 2022 has been particularly tough before Russia, Ukraine. Where do you see things going now and why?
Well, first off, thank you so much for having me on the program. And it's been a bit surprising that you've seen the markets move up here over the last week and a half. And really, the catalyst was the FOMC meeting last week, and the Fed upgraded its estimate for inflation to 4.3%. So it really marked to market what the market was already anticipating. So the Fed went from denial to acceptance. And I think the market took this as the Fed wouldn't be more hawkish than what was already being priced into the markets. But after Powell's press conference on Monday, where he said that monetary policy works through tightening financial conditions in the economy, believe it or not, financial conditions have actually gotten looser or easier by about 50 basis points since the 14th of March, retracing about 1/3 of the financial conditions tightening that we've seen. So this has really given a green light to the markets, and I think the Fed to pivot more aggressively, to lean more into a front-loaded rate hiking cycle, to get ahead of inflation. And just this morning, Citigroup came out with their expectations for 50 basis point rate hikes over the next 4 meetings, with another 2 at the very end of 2022. So I think this is going to tighten financial conditions, and I think the markets may be getting ahead of themselves. And I think we're going to probably see some volatility here over the next quarter as we deal with a much tighter Fed than what was initially anticipated.
I think it's also interesting. So we're waiting on the Fed to raise all these rates, as you're noting. And you noted that the consumer seems better positioned. Explain what that means, because the consumer certainly is facing higher inflation across the board in every way, shape, or form. That being said, you think that they can withstand some of this. Why?
I do. I would argue that the U.S. consumer is probably in the best shape they've been in over 30 years. Balance sheets are rock solid. If you look at household net worth here recently, it jumped to $150 trillion. That's up over 33 trillion since the end of 2019. So they do have cash waiting or on the sidelines to be able to handle higher prices. Also, with this price break that we've seen in energy, the wallet share, or the total spend that consumers are spending on energy and gasoline, is only 2.5%. The last time that we saw $100 oil was in the aftermath of the GFC from 2011 to 2014, and the wallet share spend was 3.7%. So at 2.5%, higher energy prices are certainly going to affect the consumer, but not to the same degree because of better fuel efficiency, but also incomes are up about 25% from a decade ago. So it's not as big of a piece of the pie as what we saw back in the early part of the last recovery that we've seen. And the other thing that I'll mention is that although higher energy prices are certainly going to affect the lowest income consumers the most, these are the types of consumers that are seeing the biggest price increases and wage gains right at the moment. So they're better situated to be able to deal with higher energy prices today than they have historically. And if you look at consumer credit, it's down substantially since the beginning of the pandemic. And for those that may not have participated with that household net worth or aren't seeing these larger wage gains, there is a lot of credit that's available for those individuals to bridge the gap until we can see some lower inflation as we look out a couple of years.
So is it always time to invest? I know that you think some of the military, all things military, and how the volatility that occurs in the markets is sometimes short-lived following, and there may be some headwinds from the EU. You noted
but for investors, I want them to get the most out of your experience. What do you tell them?
Well, geopolitical events tend to be short-lived. If you look at every geopolitical event that we've seen since the beginning of World War II, the median drawdown that you see is 5.7%. Takes about 3 weeks for the markets to bottom and another 3 weeks for the market to recover. And by using that playbook, we almost hit that exactly. It was about 3 weeks to the bottom since the U.S. intelligence had said that there was a likely invasion into Russia, into the Ukraine. And the recovery took about 2 weeks. So we're a little bit ahead of schedule on there. But more importantly, the trajectory of the markets tends to coincide with what's happening with the U.S. economy. If you go back to 1973 with the oil embargo, that was the catalyst that pushed the economy into a very deep recession. And although you had a bounce, the markets continued to move down over the next year and a half. And conversely, as you entered into the 2 Gulf Wars in Vietnam, you did see a sell-off, but you saw longer-lived rallies over the next couple of years as the U.S. expansion continued. So in thinking about where we are today, the markets are really keying in on Fed policy, where's 10-year Treasury rates going, but also the health of the economy. And even with the disruptions that we're seeing today, the economy is in a very strong expansion color per our proprietary recessionary dashboard. And more importantly, it's reaccelerating post-Omicron. So I think recession risks are low, and it's a key reason why the markets have shaken off this recent geopolitical event.
Yeah, and just quickly, as far as sectors, for example, energy is up about 5% this week. Materials has done well. Technology has done well this week. Are those sectors that you would consider investing in? Where do you like to put some money to work?
Yeah, at this point, even though energy and obviously materials has had a nice run, I do see for a longer term investor, those as attractive areas as we move a couple of years into this expansion. There's been a lack of reinvestment in these sectors because the last recovery that we had was a very different dynamic where you had ample supply and not a lot of demand. And quite frankly, in order for a lot of supply to come online for energy or materials, these are usually 3 to 5 year time horizons to see a massive increase. So I wouldn't be surprised if you see a pullback in these sectors as things normalize. But if you have a 2 or 3 year time horizon, I think these are really attractive areas to put money to work.
All right, Jeff Schultze, nice to speak with you of ClearBridge Investments. Great conversation and some optimism there, too. We appreciate it. Thank you. Good to see you.
Thanks for having me.
Plenty more to come right here on Trading 360. Our 360 Spotlight looks at the bad ETF. It's focusing on bad things, right? Maybe they're not so bad. Betting, alcohol, cannabis, drug stocks. And we will discuss the impact of the NCAA tournament and its impact on gambling. So that should be a good one. Our disruptor is Intuitive Surgical, getting a bid today after RBC Capital put an outperform rating in the 340 price target. 360 round looks at the beverage space, looking at these names and these stocks and how they performed historically during periods of high inflation. And up next, the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes through the technicals. Joel Hawthorne is here to take us through the trades for Apple, Microsoft, and Ulta Beauty. Next, here on Trading 360.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
Welcome back to Trading 360. I'm Nicole Petalides, live in New York City. It's time for the Big Three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will take us through the charts. And here to take us through the trades, Joel Hawthorne, head trader and CEO of themorningsnapshot.com. Great to see you both on this Friday. I saw you're beginning with Apple. In fact, there was so much talk how Apple has been up so many days in a row. And today I see it now down 1/3%. But Apple shareholders have really been feeling pretty good for over a week. Joel, why is this one on your radar?
Thanks for having me, Nicole. Always great to see you guys. Apple's just one of those names right now where if we look over the past couple of weeks, I know there's been a lot of uncertainty, a lot of fear in the market as of late. But if we look over the market over the past couple of weeks, I think we can kind of see here that the Apple stock has just been very, very resilient, as with the overall market. I mean, I've been very cautious, even somewhat of a short-term bear, but it's hard to ignore the rally that we've seen in Apple. And because of that, I'm bullish at this level.
And tech has done well as a theme overall. I was looking at some of the winning groups of the week, along with energy and materials. Tech has been a winner. Your thoughts, Ben, as you take a look at this chart?
Winners you mentioned, considering rates have been spiking this week as well. So to see, some of those growth names shrug off some of the concerns that higher rates come with. But, one thing, as I looked at Apple, I have to notice again, as you both have mentioned, the strength we've seen as of recent. Here, the chart shows the move up from 148 up to 174. But I want to remind everybody that if we were to zoom out a little bit, which we will in just a second, we were coming off a January high, the all-time high, if you remember, up around 183. So we're just now kind of recovering after taking a little bit of a hit here. And, well, let's do just that. Let's take a look here at, before we do actually look at the daily, I just want to point out, again, these 2 phases of development. We're going to talk a lot about that today. Here with Apple, you can see it really well defined here on the hourly time frame. You go sideways, horizontal, you break out in the vertical phase. That stopping price comes into play. And here you can see, again, the transition from one phase to the next, again, vertical to horizontal and so on. But take a look as we look at the daily time frame. Now you can see recently testing the 200-day moving average back up above the 50-day moving average. Some room to run here in terms of the RSI. You can see the well-defined trend environment to the upside as well. And again, as mentioned here, it's really interesting that with rates on the rise, that the Nasdaq has managed to shrug off some of those concerns. The Apple, has managed to shrug off some of those concerns with the broader market, the Nasdaq as well. But, Nicole, we looked at Apple about a week ago, and I had these areas of consolidation drawn on the weekly time frame, these sort of, again, horizontal consolidation phases that play out here. And I kind of think of this as a footprint or a little kind of a path that the market leaves us to follow in terms of migration of value to the upside. And you can see how we just recently, again, tested that 148 level. That was support, the lower extreme of this range. And now, as I always say, as we work our way through the middle, it opens up a door for a retest of that 182, 183 level. So this will be key to watch in the coming days and weeks here. But here you can see, again, that clear migration of value to the upside and how even that recent pullback held above that big key area in terms of number 2 here. That's the middle of the range of the balance that's being established. So now we've got a pretty well-defined lower and upper extreme to keep an eye on in this area that we've been consolidating in.
And are you worried about the lower extreme? And we have the upper and lower extreme there that Ben was pointing out. Thank you for that, Ben. Joel?
I am, but what I will say about Apple at these levels, that 182, I think, is our all-time high now, and I think we're trading so close to that number. We do know that as we start to get to some of those all-time high, 52-week highs, momentum does start to increase. directionally to those levels, even if obviously if it was just the opposite on the pullback. So I think that right now, just with the market, just with the overall market kind of breaking and trending in the direction simultaneously with Apple, I'm more interested in seeing, I think there's more probability to the upside. Of course, all good things continue as we've seen here over the past maybe 2 weeks or so. Because of that,
right.
I actually want to kind of take a look at a trade. I'm sorry?
Go ahead and finish. I'm sorry to have interrupted you.
Oh, I'm sorry. I think right now what I'm looking at is just kind of selling that 180 call and buying simultaneously a 170 call, a 175 call. That 180 call actually is going to expire in April. That'll give me an opportunity to possibly collect some premium. If we don't hit that 180 mark, we're trading right now about 173 and change, and then financing the call that expires right around 170. Buying the 175 strike that expires in May. Because if this upward momentum does continue, I think we'll have an opportunity here to see that 182 and change really get hit and possibly extend and make higher highs.
Okay. So what are your final thoughts on Apple here, Ben, as Joel gave us his trade?
Well, I think, again, in terms of what we've seen as far as value to the upside, it's a pretty well-defined trend higher still. Now, just kind of getting back to that chart that we just looked at, I wanted to point something out again and kind of stress this point here. If we could just take a look here, this area of value, this consolidation that formed around the, well, we'll call it the 147 area. Here you can see, again, the middle of this zone. And we always talk about kind of how we want to not only keep an eye on what's playing out in terms of the current area of balance that's forming, but if we do get a retracement, do we take out the key areas that were established on the way up? And in this instance, again, key support held. So as mentioned here right now, the next key hurdle for the bulls to get up above is the 183 level. If we do get above that, we're going to be looking for, again, what we see in terms of the tendencies associated with the vertical phase. We'd be looking for higher highs, higher lows, good participation, a good strong volume, basically. It's not as significant as it would seem just to take out that 183 high. We want to see value and time spent above that key level to really signal that investors, traders have accepted the new area.
Understood. In fact, at one point, you heard Joel say, right, because you have to accept that new area, new levels. Joel at one point said, he sometimes gets the inkling to be a short-term bear, but, when he sees moves like this, you go and be a little bullish. Tell me about Microsoft. Are you in a similar position with Microsoft, Joel?
Absolutely. You're reading my mind. It's exactly what it is, Nicole. In the short term, quite frankly, last time I was on the show, I was very short-term bearish because I just felt like overall market sentiment was weak. And I thought a lot of those names like a Microsoft was going to have a pullback. But right now we're seeing so much resiliency in the market. It's kind of tough to really, really be a bear and really put time on it. If you mistime those kind of moves, those knee-jerk reactions, I think there's a lot of moments where you could really feel the pain of the market and kind of get ran over. Trying to protect myself from that. So nonetheless, I absolutely want to be a bull if this resiliency can continue in the market. Definitely looking to the upside.
Yeah, so feeling the same way right now about Microsoft. Ben?
Well, we were just talking about Apple in terms of its attempts to recover here and get a rally going off those lower levels down around the $148 level. But Microsoft in a similar situation, still some hurdles to get up above, but with the broader market here has managed to come off the lows that we saw back in January, in February, and in March we tested that 270 level. Here you can see we formed a bit of a triple bottom now, but again, we haven't really taken out anything significant to the upside in this instance, holding below the Feb highs that lie up around this 315 area, and then you have the Jan highs well up above around 340, 345, we'll call it. But as we step away from this intraday, which again to me just is still kind of in a bit of a range here, not really seeing that same enthusiasm to the upside or really well-defined migration of value to the upside relative to what we just talked about with Apple. But Microsoft here on the daily time frame, this is what has me a little bit concerned, and I'll point to something else in terms of the weekly time frame, but the death cross coming into play, the 50-day moving average dipping down below the 200. Look at how the RSI may be rolling over here at this point, and for the most part on the move up here, volume's been kind of limited in terms of you'd like like to see a little bit more participation from investors coming off a triple bottom like that. And then I just wanted to take a step back. Remember those balance areas we had drawn in terms of Apple? And I mentioned again how we were unable to take out key areas that were established on the way up. Well, look at what Microsoft has done now. You can see again, 1, 2, 3, 4, 5 areas of consolidation that formed at higher and higher levels. So the trend environment in place to the upside. But then look, remember Apple was unable to take out the middle of the most recent area of consolidation. In this instance, it's numbered 4 here. Look at how Microsoft did. It not only took out the middle of number 4, it took out the lower extreme of 4. And now, again, as I mentioned with Apple, if we were to get a breakout to the upside, Microsoft's spending an amount of time down at this lower level. So my point here is if we're forming value and trending higher to the upside, why all of a sudden is number 7, or this should be 6 labeled. I'm sorry, I got a little bit aggressive on that. But why all of a sudden is the one that's labeled as number 7 below number 5 at this point? It just doesn't really kind of feed into that trend environment to the upside kind of mindset. This actually kind of invalidates that in many ways.
So some apprehension there based on Ben's charting. Joel, your thoughts?
Absolutely. Definitely looking to the upside here. Looking to play the bullish upside, selling a 312.50 call that expires April 1st, while simultaneously buying a 295 call that expires May 20th. Risking $1 to possibly make 43 cents. My break even on this trade is 302.13. Microsoft's kind of trading in that range roughly right about now. So just really needing a little bit of a push to the upside and possibly even staying here where we are in this range to possibly break even to making a profit.
And people really love tech. I mean, when you look at the big picture here, for tech, for growth, and while they may be concerned about higher rates, they have a hard time giving it up. Last but not least, let's turn to a completely different topic, and that is beauty. In fact, when you look at Ulta Beauty, and this is something you remember when Amazon started to really take on beauty too, there's really some high margins that can happen on beauty products for companies. Tell me about your thoughts when you look at the chart, Joel, why you like this one, or do you like it? Ulta Beauty.
Absolutely. Ulta is one of those names where I think that when we think about just sentiment for just the world we live in, I think everyone has just really been pent up, really just excited to get back out. I think a sector like just consumer sector like Ulta is going to thrive. And right now, I think as we in the Midwest here see the weather warming up, the mask mandates are coming down. I think Ulta will definitely benefit from all of that, as they have. I mean, this is a very strong stock. Looking at this stock overall, I'm looking at a weekly, and we kind of can see here that all-time high being about 422.43. Just a lot of momentum there. So I definitely like this one to the upside.
Yeah, and this has been a darling. I mean, I know there's been some volatility, and Ben will show us the charts, but you know, there was a time that everybody loved Ulta, right, Ben?
Yeah, there was, and you know, there was a lot of optimism in terms of tied to shares here, the reemergence trade as well. Everybody expecting to go back to work, and ultimately some of the demand that would create. And, you know, as I look at Ulta, I'm noticing here a couple things. Well, first and foremost, this is another one of these names, another stock that's been trying to claw its way back again after bottoming out here. And we're talking about down to 336 at the end of January. Notice again a situation where, as you can see, the Feb lows held up above the Jan lows, and in this instance, again, the March lows as well. So we're starting to see some higher lows come into play. But look, we're still, again, just kind of in the middle of this range. We talk about these bell curve type patterns that we have. Again, here's that upper extreme, the lower extreme, and this is kind of the meat of it. You can see how we've spent a lot of time around this 370, 380 area. I want to take a step back from Ulta on the hourly time frame and just this range that we've been in since the beginning of the year, again, from 422 down to 336. But take a look here, as you can see. Well, we have seen some intraday volatility as well. You can see that in terms of some of the big candles on the daily time frame, but another instance where we might be about to cross over here in terms of of that 50-day, the blue line taking out the 200. We always call that the death cross. Sometimes a little bit more impactful than others. But again, you know, just want to point out here that since the beginning of the year, basically, we have been kind of clawing our way back, but still holding up above some highs that we saw, again, talking last summer and into the end of last year. Lastly, taking a look at the weekly time frame with me, you'll see, and I didn't draw the boxes on this chart, but again, another instance, we're on the weekly time frame. And to your point, Nicole, the stock shares have done very well. We've seen nice migration of value to the upside. And in this instance, maybe a little bit more hard to see or not as well defined, but here we have a consolidation area that formed around 219. Again, it looks like one that formed around 270. And as we go on, you can see the most recent prior to the one that we're forming right now being around this 330 area. So that's kind of the middle of this range, 325 to 330. You can see here how while forming the current area balance from last fall into, again, this most recent run up we're seeing here, we retested that lower level and held. So this is key. Similar situation in terms of Apple. Now we're working our way through the middle of the balance. The bulls want to see us retest that 422 level, break out, establish a new area of value at a higher level. Ultimately, that'd be continuation of the trend that we're looking at here. We're talking bottom left corner to top right corner. There's been some energy to the upside here. Just right now, we're kind of consolidating.
Yeah, people love that, right? Bottom. You know, when you look at the bottom on the left and in the upper right, that would be a beauty. Tell me, Joel, your final thoughts on the trade.
Absolutely. Just exactly that. Run into some consolidation here. Because of that, I want to sell the 392.50 put that expires next Friday, while buying the 380 put as well. This is the a bull put vertical. I do think that we'll get a bit of a bounce, maybe a little bit higher high here in the short term. Risking $1 to make 44 cents. Break even is 388.70. So we're slightly above that right now, trading roughly 391 and change. If we can kind of stay here to even slightly grinding ourselves higher, I think here this trade has the potential to be successful.
Yeah. Great to see you. This was a great big three. Some really catchy names with Apple, Microsoft, and Ulta Beauty. Joel Hawthorne of themorningsnapshot.com and Ben Lichtenstein. Thank you always very, very much. Good to see you both. Coming up next, we're ready for a spotlight of the bad ETF. Is it bad? Well, and maybe betting, alcohol, cannabis, drugs, it's all in that ETF, and that's next.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome Welcome back to Trading 360. I'm Nicole Petalides live in New York City. So we are now seeing all red. When we started the show, only the Nasdaq had been in the red. All four of the major averages have turned a bit lower here. The Dow right now is down 44 points, 34,663. The S&P's down 14 at 4506. And you can see the Nasdaq down now 1.1%, 14,596. And the Russell down 0.5% at 2065. It is time now for our 360 Spotlight. We're looking at the gambling space and more. To discuss all of this, we'd like to welcome in Tommy Mancuso, president and founder of the Bad Investment Company. So you have your ETF, and I like the branding, bad. Okay, so it's bad but good. Tell us a little bit about why this was created and why this is probably really seeing some value at this point.
Absolutely. So the original idea of the BAD ETF came from a little bit of a contrarian view towards ESG to some extent. But when we kind of peeled back the onion and looked at the core values behind each of these industries, when we look at the betting, alcohol, and drugs primarily being pharmaceuticals, there's a lot of value there, and they have withstood the test of time. They've undergone government scrutiny, and they've actually thrived under those certain circumstances. And there's a lot of clarity when it comes to this drug, something that ESG funds lack, as we start to see more fund managers implement energy and all that type of stuff in their funds. So when we kind of look at these industries, betting, alcohol, and drugs, there's a value play to them. You look at the betting, there's a growth aspect. It's expanding from a legalization standpoint. You look at a little cannabis that we have in it. We're just, in the news as of lately, we're seeing that the House is looking to vote on it. It's going to get moved to the Senate. So just look at all the tailwinds and the value underneath the underlying holdings in it. We think it's set up for truly sustainable long-term success for investors at the end of the day.
Right. We used to call some of these the sin stocks, right? And now it's the BAD ETF. And it really has obviously so many different things in it. I'd like to break it down a little bit. Betting is such a big part. I mean, right now, everybody I know is obsessed with March Madness. You were focusing on names like DraftKings and Penn and BetMGM and Caesars. These are some of the names that you like. You talked about some value there. Maybe we could just do a few seconds on each one of the groups. So tell me a little bit about that.
Absolutely. So in regards to DraftKings, kind of talking about that one, they're the forefather, in my opinion, of bringing the online sports book to you, the consumer. Now they're continuously reinvesting in themselves, and that's going to pay off long term. When we look at an investment, we're not looking for the immediate quick buck. We want to see what's going to be successful 3, 5, 10 years out from now. And I think DraftKings really has the capability and the brand to support that from a long-term investment standpoint. We look at Penn Gaming. They have their brick and mortar type of business model, but they've embraced the Barstool Sports culture. And that, I believe that culture has a lot more influence than what people maybe originally think. So you combine that with their innovation, it's going to provide a nice tailwind for Penn Gaming in the long run. There's a lot of young people involved. Again, it kind of sets them up for long-term sustainability. Then we look at BetMGM. They've obviously embraced the online sports book. They're going big into their online advertising, but they're also a behemoth, and they have their Vegas resorts and all that type of stuff, where they're going to be able to really stick to their traditional customers and attract new consumers and customers when it comes to their online sportsbook. Same deal situation with Caesars. Again, they've got their luxury resorts, and they're embracing that online sports book. They have they have their customers already, and now they're just going to continuously build on that, especially as we see more states legalize sports betting across the United States. So.
Right. Yeah, and even though some of these stocks have pulled back, they're working, right? You see people are gambling. You know that you have a reopening trade there too as people get back to the casinos. As far as drinking, people, there's no doubt there were a lot of stats about a rise in alcohol consumption, particularly during the pandemic. What I am curious about, and I see why you're putting these in there, what I am curious about is your thoughts on cannabis. People would love your expert advice on that. You did mention what's going on in Washington as they're moving forward with basically, not making it illegal federally. I mean, that's basically what they're moving forward with this act that they're moving forward, but it may really hit a wall. So in the meantime, because it's not guaranteed. In the meantime, the cannabis stocks, we look at MJ, for example, that group's down over the last year, maybe 50%. But you think at some point they'll have this jump?
Absolutely. I think, again, as more states and the government look to generate additional tax revenue, they're going to be more open to the idea of legalizing the cannabis space. And when, right now, as these companies are building their infrastructure and everything that goes around building it, a successful cannabis company, once they flip the switch, which will eventually happen, then these companies are going to be in a great position to already roll out all of their products and attract new customers. We'll see a ramp in marketing because there's a lot of restrictions in that. So when you build some of the awareness around the cannabis space, you're starting to see a little bit of transition of people kind of look at cannabis as not so much a vice, but as sometimes a truly medical deal. We've seen people get off of Xanax and you're starting to people go off into more of a cannabis type of product for sleep purposes and whatnot. So you add all those up scientifically and legalization, it's going to provide a nice tailwind for the cannabis industry in the long run, certainly.
Yeah, and there certainly seems to be a lot more support for medical marijuana rather than recreational. Easy for me to say. That being said, last but not least, as I look at the allocation of the names that you have in the ETF, how often are you changing the names? We saw some of the heavily weighted names in there were Kronos and Canopy, for example. So those were in the Canopy space. How many names are in the ETF and how often do you change them?
Yep. So there are 57 total holdings, actually 54 now. We just had a rebalancing prior to the quarter, and we rebalanced it on a quarterly basis. And that will be based off of certain market conditions, the market caps, and things of that nature. So again, we like to have a broader perspective when we look at all these industries, and this is why we took this multi-sector approach. But we do rebalance it to answer your question on a quarterly basis. And again, we're just trying to get what are the highest quality companies in each of these and focus on those specifically at the end of the day. So
It's great to see you. What is the picture? I just am curious,
So
in the triangle and the thing behind you.
That is our bowl, our logo. It's the Bad Investment Company. And then the shirt is a little spinoff of the DARE symbol that we did that says invest in betting, alcohol, and drugs, NYSE BAD. So again, we're embracing the theme, certainly.
Yeah, I think people will like the bold part too. Thank you so much. It's wonderful to see you. Tommy Mancuso of the Bad ETF. Great to see you in the Bad Investment Company. Thank you.
Thank you so much. Have a great day.
Coming up next, you ready for the disruptors? Tom White will be joining us. In fact, he'll take a look at Intuitive Surgical. The company is up nearly 50% over the last year and got an upgrade. You'll want to hear more about it. Tom White's all over it next.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy. A measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim. by TD Ameritrade.
Welcome back to Trading 360. It's time for the Disruptors. Tom White is here for today's disruptive company, and that is Intuitive Surgical. ISRG is the ticker symbol. It may be under pressure this year, down about 20%, but it has been a good one over the longer term and got some positive comments and outperform at RBC and a nice price target. Tell me your thoughts, Tom, why this one jumped up at you as a disruptor.
Well, I think the growth in this area is exponential, right, globally. But most of the machines here, the Da Vinci, which is a robotic surgical instrument that they sell, there's only about 6,000 of them that they've sent out to hospitals across the globe. But this continues to move up in numbers. And then on top of what they get when they sell that product to hospitals is the services behind it. So, right? This is for laparoscopic surgeries, soft tissue procedures, and they're going to expand into other forms of surgical procedures. Now, their operating model is built to improve with age. As more Da Vinci systems are installed, the company will generate a larger percentage of its sales from instruments and accessories sold. The company's has a huge runway to expand to thoracic, correctal and general soft tissue procedures. And with the 6,000 units that they have in place, that's more than all of their competitors combined. So they've got about 80% of the market share in this. Their increase, 13% in procedural growth for 2022. Its compounded annual growth rate is about 12.725, and this is historically a low level compared to 15%, which is what they've seen before. But you did mention the RBC Capital analyst initiated coverage of Intuitive. They put an outperform rating, $340 price target. That's about 20% above the current share price in there. And this is a $6 billion market for this firm. And as they continue to get more Da Vinci surgical systems out there, the expansion is pretty robust when you look at it on the service and sales side of it also, and the expansion into other areas of surgical procedures.
Yeah, and the demand continues to increase and the technology improving, to your point. Tell me a little bit about the trade here as you take a look at this chart. And you know RBC, of course, has that 340 price target that you mentioned.
Yeah, and I think this is a difficult one because if you look at a chart of it, it's hitting up against some key resistance points. So I don't want to be too aggressive when looking at an example trade in Intuitive. It's a high-priced stock, right? So using the option market for leverage might be the way to play it. So the trade that I looked at was basically just a little bit bullish, but still having a neutral stance where if the stock doesn't go higher, I can still be profitable on it. So the trade I looked at was going out to the April monthly cycle, so 20 days till expiration, and I'm going to sell an out of the money put vertical. They have earnings at the end of April, so I kind of want to avoid that event risk with the earnings. So looked at the April monthly cycle, selling the 275 strike put, and then against it because I want to stay risk defined. I want to know what my downside is. I'll buy the 270 strike put, creating a short $5 wide neutral to bullish put vertical. If I can collect $1.60 per spread on that, that's going to be what I can possibly make on it. $160 per spread with about $340 in risk. Now, the probability that that short 275 strike is going to be out of the money at expiration, which is what I want the stock to stay above 275, is over 60%. So you have a high probability of success. You're giving yourself a cushion to the downside before you start losing money on this type of trade, and it avoids that earnings event that I mentioned on the 27th of April. So this might be the way to play it, a little bit more cautious. You don't have that much reward, but at the same time, you're giving yourself a higher probability of success on this type of strategy.
Yeah, I like that. I mean, you're playing the odds there and looking to the upside. That's that's excellent. Thank you for that example trade there on Intuitive Surgical, our disruptor of the day, with Tom White. Nice to see you, Tom. Have a great weekend. Thank you.
Thanks.
Coming up next, our panel is ready to look at the beverage sector. looking at this inflation situation and how does it affect these companies? PepsiCo, Constellation Brands, Molson Coors. We'll have an expert panel next on Trading 360.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select Time Frame to adjust the time intervals or to favorite a time frame. Select Style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes
Oh,
away.
yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. Stocks and stock index futures products are selling off into the midday trade with disappointing economic data and rates on the rise to new multi-year highs. Let's begin with the pending home sales, which fell for the fourth consecutive month. The Feb number is down 4.1%. The index declined to 104.9. They said month over month contract signings in February were down across all regions except the Northeast. All four regions registered a decline in year-over-year contract activity. The S&Ps back to 4,500. They're down by, well, lower by about 1/3%. Take a look at the Nasdaq. It's leading lower, down around 1%, and, well, not uncommon to see and not much of a surprise to see tech that is under pressure with rates on the rise as they have been this week. The TYX 2.64% this morning. The TNX, that's the 10-year, to 2.5%, the highest we've seen since the spring of 2019, and the shorter end has been on the move as well, leading in many instances. The FVX is at 2.52. Now, still a handful of individual Fed speakers expected to provide further insight on where the Fed's positioned headed into the May meeting. Mary Daly, Thomas Barkin, and Christopher Wall are speaking throughout the day. Earlier in the week, Fed Chair Jerome Powell and others signaled a willingness to consider raising by 50 basis points at the upcoming May meeting if need be. Bonds today to 146.20. They're down around 1.25%. This has been your TD Ameritrade Network Futures Market Update. Now back to Trading 360 with Nicole Petalides.
Welcome back to Trading 360. I'm Nicole Petalides, and thank you to Ben Lichtenstein for that report. It's time for our 360 round. We want to talk all about beverages, and we have an expert panel here to discuss this topic, particularly as we've had inflation and supply chain issues. Bill Kirk is with us, Managing Director, Senior Beverage Analyst at MKM Partners. Chris Wang, Research Director at Runnymede Capital Management. Thank you both for being with us. I know you have some picks, some names you're more neutral on. So, Chris, I'll start with you on the big picture. I mean, obviously, we see a lot of hurdles, but demand is still well and good, right?
Yeah, the consumer so far is holding in, but all concerns are obviously on inflation and its impact on margins going forward. In the past, all these companies have dealt with commodity inflation over time. I mean, you've seen high oil prices in 2008. Even sugar prices spiked 70% higher than they are today in 2011. So they are used to dealing with individual inflation problems, but this time it is different. You're seeing inflation across all the parts of the business, whether it's labor, shipping rates, or commodities. So it is a more complex problem for these companies, but I think they will be able to weather the storm, especially a lot of these premier brands like Pepsi and Constellation Brands.
Mm-hmm. And Bill, I know TAP is probably your best buy right now. You can expand as far as stocks to buy, but I noticed you had a lot of the beer names. When we look at beverages, that's obviously a hot area. I think of soda. And I don't know, what about hard alcohol? What does your coverage really entail, and what themes are you seeing?
Yeah, and thanks for having us. And there's no better day than a Friday to talk about beer and hard alcohol. So I cover the U.S. alcohol sector. As Chris kind of mentioned, there's obviously a lot of inflation, but within alcohol, the problems get compounded a little bit with all the shifts back between bars and restaurants, the opening and closing, back to the grocery stores. So all those shifts create different package needs, right? Bars and restaurants need kegs, grocery stores need cans and bottles. So it's been difficult for them to plan for all that volatility. On the packaging side, obviously the price of things are up. So it's a kind of compounded issue. They do have a lot of experience dealing with it. They do have, very robust hedging programs. So the best hedging programs there are, but it is a battle. They need to raise price to offset the inflation. So far, they don't quite seem willing to fully offset the inflation they're feeling. I like to bring up the example of green beans. Green beans are taking almost 10% pricing year over year. Why can't some of the best beer brands in the world do that? This is the time to lean on your brand strength, lean on your brand equity, and not absorb all that inflation, right? Pass it on. We've seen times where large price increases in beer. In 1991, the federal excise tax on beer doubled. Prices went up 13% for beer. Beer still grew when it went up 13%. So this is an inelastic category, bodes well for strong brands like the ones Molson Coors has. Our push would be take more pricing, raise prices a little bit more.
And, and I see what you're saying. There's such stiff competition. I wonder if they're afraid to do exactly that. Chris, you were taking a look at Pepsi and Constellation Brands. Are those names you like?
Yeah, those are two names that we definitely like. I mean, they're premier brands where they will be able to take price, and they have been taking price already. I mean, Pepsi in the fourth quarter, they had net pricing up 7%, and volume still grew 5%. So you are looking for companies that are able to use their brand to take price and hopefully not affect volumes too much, because as consumers are definitely weary of paying more wherever they go, whether it's the grocery store or gas at the pump, they are going to look to trade down. So you want premier brands that are able to take price and not affect their business overall too much.
Right, and that dividend yield. I see that you have dividend yields on both of these, and people like that. I mean, that's also, an added benefit. Bill, I'll give you the final thoughts here because, there is stiff competition. There are high costs for not only the supply chain and inflation, but labor. Final thoughts here. Overall, you still like the group?
I do. The more difficult spot would be categories where people shop by style. And what I mean by that is take wine, for example. People shop for cabs. They might have a little brand loyalty, but they generally shop by style. Craft beer, you generally shop by style. You want a hazy IPA or you want a stout. You don't rely as much on the brand. You explore the style a little bit more. Those are places where pricing is going to be harder to achieve, right? It's going to be harder for wine and craft beer to raise prices than these bigger brands we're talking about. So, when we think about the environment right now, even if the consumer's feeling a little bit pinched, if you recall going back, to the great, kind of financial crisis, 2008, 9, 10, beer grew. The consumer was in tough shape. Beer grew. So the point I'd like to kind of bring home with is these are really strong brands, just like Chris said. That is valuable in times where inputs are difficult, inflation's difficult.
Yeah, good to see you both, and cheers. Thank you very much. Bill Kirk of MKM Partners and Chris Wang of Runnymede Capital. Thank you both. And thank you, friends, for being with me here on Trading 360. I'm Nicole Petalides. I'll see you at 2 p.m. Eastern Time for the Watch List. Fast Market is next.
It's a 13-hour flight. That's not a weekend trip.
15 minutes.
Oh, wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. Nasdaq. Rewrite tomorrow.
It's a 13-hour flight. That's not a weekend trip.
15 minutes.
Oh, wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
market. And this will put a scare into you, about 4.5%. So that consumer sentiment data, and this was the final read, just a little bit lower. It seems like it's stabilizing just below the 60 level, but we're still at 11-year lows, and this is a forward-looking number that we continually talk about. Your thoughts on that?
This number's huge, and as you mentioned, it really is going to be driving consumer demand going forward. And with consumers representing 70% of GDP, you got to keep an eye on this one. I mean, one of the things that, we were looking at the University of Michigan consumer sentiment number that came out today, but if you go to the Conference Board, one of the things that they're showing is kind of the current versus present expectation. That is now at the lowest level that we've seen in multiple years. And we're in one of those ranges right now where it has, I don't want to even say tended, it has predicted or at least led into recessions multiple times in the past where we've seen that widening. And basically what that means is that as you're looking forward, what do consumers think, there are opportunities for jobs, there are opportunities for spending look like in the future. And right now with the inflation, with what we're seeing at the pump, with what we're seeing at mortgage rates, consumers aren't very positive about the future. And what does that mean? That means that they could be curtailing their spending, and that could have a pretty negative effect on GDP going forward.
Definitely. And just going over some of those points that you mentioned here, Joe, the lowest since 2011 as far as consumer confidence as a whole. But I think you brought up something that should be clarified here is the fact that the expectations component went down to 54.3. In February, that was 59.4. And the current reading is still in the mid to upper 60s. So is that going to be the catalyst, is that the expectations are starting to wane and get worse while the current conditions are still pretty elevated. Everybody keeps talking about like, hey, the economy is doing well, growth is doing well, but at the same time, expectations looking out and those forward-looking numbers are still pretty poor. Nick, when you look at the VIX here trading, or hovering around that 22 level at this point, it was under 21 earlier today. I looked at that as a reflection of the strength that we've seen over the last week and a half, right? But is it a false sense of security here for a lot of traders and investors where, hey, everything's fine now, the VIX is coming off, the uncertainty is starting to wane from this market, but then you've got Ukraine, Russia, you've got a hawkish Fed, you've got rate hikes into an inflationary period. I mean, did everybody stop reading the news or listening to us?
You're making my job easy, Tom. You're the trader. I'm supposed to remind people about that, so I appreciate it. Like drop the mic, you can just walk out of here. This is good. Yeah, I think it really is. It's a fascinating, VIX right now in general, and the Nasdaq as well. The VXN is insignificantly. You think, oh man, tech stocks are going to get the most beat up out of all these stocks because of all the rate stuff we just talked about. You get 1 week of rally and everybody's like, oh, we can get back to 20. We're still historically elevated, right? We've been saying that for a long time. You take the average and it's, 15-ish. So, but near term, we're back to where we were, pre-invasion. And I think that it just tells you, again, like I say this every time I'm on now, it just tells you how the markets are really trying to be forward looking. The market said, look, we understand there's a war going on. And, right now it hasn't worsened lots of these numbers, right? We get consumer confidence next, I think it's next Tuesday morning. I'm watching that one really closely. Like where does the consumer come in on this? That's important, right? Oil obviously is eating at everybody's budget right now, like Joe mentioned earlier. So those things are out there, but the market already knows that, right? It's priced in $113, $415 oil because that's where we're trading, right? So what it's saying now is the possibility of another shock right now has gone down a little bit, right? It's digested this stuff and it's gone down, right? We're not at the verge of the next thing. Now, if the war escalates again, and it could in a lot of ways, I think you'll see that number very, very quickly pop back up. Similarly, if we have some big misses and the inflationary pressures continue to just ramp up and we don't get that top off that folks are expecting, I think it could happen there. And we could also see a pop back up on GDP numbers next week, because right now, I think it's pretty well known that we're negative net growth, right? Inflation's outpacing GDP. But GDP is strong. Well, maybe that's good, right? If GDP is really weak and inflation is this high, I think you could see a shock there. So there's absolutely, to your point, reasons this thing could quickly pop back another 5 points and get back to the mid-20s and kind of be at that fever pitch kind of feeling again. But right now, we're saying going into this weekend, even with a bit of a sell-off today, the market feels like some of these things have topped and are calming a bit, and that's getting priced in right now.
Yeah, I know what you were going at there, Nick, talking about stagflation perhaps coming into the market here if growth starts to slow at at below the pace that it's at right now. And a lot of people, a lot of market watchers have been, kind of, putting that out there. We haven't used that term. I mean, that's a 25-year-old term, right? I think we've only seen it once. Right. So, that could be a possibility if we see growth slow as the inflationary pressures don't wane and consumers stop spending. But Joe, I had the heat map up here, and when I look at a market that's being led by energy, of course, because crude oil reversed and is now higher, up about nearly 1%. But you've got energy, you've got utilities, you've got real estate that are leading, financials, of course, because we're seeing a pop in those yields. When you look at that heat map and you've got technology waning, you got consumer discretionary starting to get hit a little bit here, is this like a warning signal that, hey, maybe these rallies that we've had over the last week and a half should be sold or could possibly be sold again?
Yeah, I think Nick has taken the mantle of Kevin and being the positive one on the panel here today because I look at still kind of fading the rips and buying the dips if we start to trend back down towards where we saw those lows at the beginning of the month. I think when you get opportunities like this, the S&P kind of failed that 45-40 level, that 45-30 to 40 level that we've been kind of looking at as resistance. Now we still got the rest of the day, right? And we're talking about when you're talking about the 45.30 versus the 45.40, you're what, $10 on a $4,500 product. So you got to put things in perspective. But there is some technical resistance there. And what is resistance? Resistance is really psychology, right? And if enough people are looking at a certain level and they see that failing at that level, they might become a little bit more bearish. I think when you get the VIX down to the 21, 22 level, there's nothing wrong with using this as an opportunity to put on some of those hedges as we head into what could be. I don't want to say a tumultuous weekend, but we don't know what's going to happen over the next 2 days, 20 days, 200 days. And if you're being given the opportunity at a much lower level to kind of get some of those hedges in, as opposed to 38 VIX where we were at about 2 weeks ago, sometimes it's prudent to kind of take that step going forward.
Definitely. And one of the areas that's a little bit weaker today, it had a decent week earlier. It bounced off of basically 52-week lows that we saw as consumer discretionary. You're talking Starbucks, you're talking Disney, McDonald's, Amazon's a big component in there. Nick, when you look at this sector, it's still down about 10% this year, off of nearly 15% from all-time highs that we saw just last November. Is this the canary in the coal mine here where, hey, if these consumer discretionary names continue to wane a little bit, that this is, what's going to happen for the economy? Because as Joe mentioned, that consumer spending component of the economy is so important.
Well, it is. And, certainly we don't know. We can't call one thing an indicator and look around. But you tie it to oil, like Joe said, kind of right at the onset here. It's kind of the theme of the show so far. It's like, you are dollars and dollars, more to fill up your tank of gas, right? Or your lawnmower, or your snowblower, depending on where you live, right? Like it's a real cost, and though you have to make budgetary choices, right? So, and those add up for almost everybody at these levels, right? At these price levels, it's not just affecting sort of low income folks; it's affecting everybody. And we get back into going to work, you're driving more. All these things really matter. And it does, I think, at least at the top of line from a sector perspective, weigh on investor confidence that people are going to go out and be able to buy, as many $4, $5, $8 cups of coffee as when you were paying half to fill up your tank of gas, right? You make those choices. That's it. I will say this is not a market indicator at all, but around here in northern North Chicago, everybody's on spring break, and I know like every family is at Disney right now, and people are treating this as, so you kind of have this COVID effect too. Hey, we had COVID. Hey, we got triple vaxxed. Hey, we're going to go take a trip right while we can. So I think it'll be interesting to see as earnings come out, like, are the parks doing well for Disney? How is the walk-in business for all of these retailers and consumer discretionary companies? Because there's this sort of, built up demand, just locally seeing to get out and go do things that are different than you've been able to do over the last couple of years. And I think those two things are the push and pull here of there's really high costs, but people are willing to pay that right now to some level because we've been so, cooped up for so long. So which one of those wins? I think that's what we're debating here. But I think those are the forces at play in my my narrow view.
Yeah, of course, Nick. Everybody from the North Shore is down at Disney. I mean, that's an annual trek, right? Us guys from Chicago. Yeah, us guys. Home. Yeah, we'll do staycations here downtown in Chicago. But Joan, Nick makes a great point. Right. Some of the brand names within this consumer discretionary sector are important, and they're big components. You look at Tesla, you look at Amazon, you look at Home Depot. I got the heat map up here, and Nike's been struggling. McDonald's has been struggling. Starbucks has just been annihilated. Your thoughts here on this sector?
I think you look at this sector from a barbell approach, right? Mm-hmm. You either want to be on the real low-cost leaders, or you want to be on the high-end stuff. That's why you see kind of the pullback in Starbucks. You see a little bit of a pullback in Home Depot. You see a little bit of a pullback in Target. Those kind of mid-range consumer discretionary names, those are the ones that are going to get affected because of the disposable income effect of the higher oil price. I think at the real low end, there's some insulation there. And I think at the higher end, you see even more insulation there because, depending upon where you kind of fall in that socioeconomic poll, that's kind of shows you how much you're affected by the increase in gas prices. And some of those higher end brands, as you're talking about the Teslas, they can kind of sustain some of that. But at the same time, we'll see how much further that can go. Tesla's had its own positive news this week. We saw a dancing Elon, and we've seen a lot of positives for that stock this week. And, it's basically bounced off that 700 level quite nicely back to where we're at right now. So we'll see what that looks like going forward. But like I said, I think when you're looking at the consumer discretionaries, you look at a barbell. You either look at the real low end or you look at the high end, and you kind of fade the stuff in the middle.
Yeah, definitely. Brands maybe outperforming maybe some of the, the Starbucks and the McDonald's, some of those bricks and mortars. But you did mention Tesla. Shares are down about 4% this year, but it's had a pretty solid week so far, up about 10, 11% this week, up 15% for the month of March here, Nick. When you look at this stock, they just opened the Gigafactory in Berlin. As Joe mentioned, dancing Elon, which was just embarrassing. I'm glad he's not embarrassed because I'm embarrassed.
Balmer.
Yeah. Oh, Joe, that's a great point because I can't watch any of those YouTube videos of Balmer at the Microsoft shareholder meetings and company meetings. Those are embarrassing. But Dan Ives did come out with a positive note on Tesla today, Nick. Could be a 2 million unit run rate for 2022, but then you've got some supply chain issues still with every automaker. Your thoughts here on Tesla?
You do. I mean, at least you can be asleep at the wheel and the Tesla can drive for you, right? So, it's got its upside there, maybe. I don't know, but look, it's fascinating what Tesla's done, and one of the reasons that they've done well. I've talked to a couple folks in manufacturing recently, and there's this internal drive at Tesla to be able to use kind of whatever's there and to scrap and continue to build and produce. And what that's allowed them to do, and talking to some folks kind of close to it, they can over-engineer their stuff themselves, right? Meaning, if you can't get the microchip that can do this, but you can get the one that can do this, they can in-house re-engineer that, make that chip fit for purpose, right? You might not need I'm making this up, right? A quad-core processor to put your windows up and down, but they can re-engineer that in-house, whereas some of the bigger kind of out-of-the-box manufacturers have to go and just wait for the chip that they're putting into their car. And you've seen Tesla be able to deliver, across the board, battery technology, solar technology, and cars, right? Yes, they're not producing as many vehicles as, Ford or GM or, a Volkswagen, but they've been able to stave off those supply chain issues in an almost completely different way. And I think it just goes to the innovation and the ability to continue to scrap almost as a startup, even though they're in the S&P 500. So just a totally different sort of take in a realm on this. And I think you have to take those kind of points into consideration, because they just don't run it like a normal company. Yes, everybody's CEO is not out there, dancing and doing whatever else Elon's doing on his free time, but it is a leadership mentality that's very, very different, and a scrappy one that will kind of continue to push. And then you factor in how much they're working on scaling up across the globe. Germany, right? Obviously, they're producing in China. I think Austin's on the list, right? They're continuing to build out factories and build out the ability to produce cars, and they're doing it without any of that technical debt. They don't have this baggage of old factories and retrofitting. It's extremely automated when they set these factories up, and they're learning and changing those factories all the time. So when parts become more available, whether that's because of supply chain issues easing or bringing some of that production in-house, they seem kind of like a coiled spring, ready to really be able to produce more units, which I think is where that memo might have come from this morning, because they're just all about automation and process improvement, and that really helps you a lot. As those input costs ease, you don't take any more cost on really to produce more, and that kind of helps the bottom line.
Right, and Joe, with the advent of $6 gas, I'm sure you're experiencing that out there in California, like I am here. And this is also a demand issue, right? So they can't make enough to, basically appease the demand in electric vehicles with oil prices above $110 a barrel. Is that going to be the only issue for Tesla? Because it seems like you can order one now, but you're not getting it for months.
I mean, it could be. You got to remember, a third of the Teslas on the road are out here, in California. So we see quite a bit of them. And when you think about on the supply side, we see them out everywhere. But I think the bottom line with Tesla is they've got a marquee line right now in the Y, and I think that is kind of really pushing this name going forward. I think higher oil prices will increase demand for EV. It's just a matter of where's that intersection between the parts that are needed for these makers, the demand, and then now you're adding that third component to it, and that's kind of the disposable income. I think that a couple bees in the bonnet for Tesla, if you will. They got the new partnership with Hertz, where Hertz is now adding that Model Y SUV to its electric vehicle. Plus, they announced earlier that they're buying 100,000 of the Model 3s, and I think that could provide some exposure as we start to see more and more business travel start to pick up with people that are now getting exposure to the Teslas and seeing if this is something that they would want going forward. For me, it's a valuation thing. It's always difficult for me to kind of look at that upside and say, yeah, I can grow into those numbers. But it has, and I think when you're looking at the stock and you start to get if it does start to kind of pull back, maybe to that 850 level that we saw before, you might not get another chance down at 700, but I think on pullbacks, this is something that looks a little bit more attractive.
Yeah, and to that point here, Nick, you've got an example trade for us in Tesla. The stock's trading just over $1,000. Like I said, it's had a nice run over the last couple of weeks. How do you want to look at this for an example trade?
Well, Joe, I don't know if Joe looked at that or not, but he hit my chart kind of my chart mentality as well. It's had such a big run, and I think that we've seen over the years, as if you bet against Tesla, I mean, it can really be a painful experience, right? And the valuation's so tough, but is it a gas play? Is it an environmental play? Is it a government refund check play? Is it a Elon Musk, leading the free world of innovation play? I don't know, but every time it seems like they're down, there's sort of there's some reason that they go back to 1,000. Right? We've seen this play a number of times, but you look at that chart and it's just such a steep line over such a short period of time. I worry a little bit that there is a short-term pullback just looking at how quickly it's ramped up there. But I was looking at the same 850, 860 level that Joe was, and we'll call it stupid simple trade Friday maybe. Simple put spread, nothing tricky, one by one. I was looking at selling the 860 puts, buying the 850 puts April 14th. So that puts us, if I got my trade date right, that puts us about 20 days out. That's just the regular April expiration. It's a little bit different. It's a $10 wide spread. You're only taking in about $1.30 on that trade, but it gives you a huge range, well outside of the expected move of about $115. So the ball's not crazy high, but it gives you tons of room to adjust if you need to, and it allows the stock to come back down significantly from the rally that it's seen, but still taking a net long position. It is a $10 wide spread, so say you sell it for it's about $1.25 right now. You're looking at maximum loss of $875 per spread, only collecting $1.30. But again, it's a very high probability trade, letting the stock pull back from these levels. So not an extremely aggressive delta position by any stretch. And the risk return reflects that it is a high probability trade relative to where it's trading right now.
Yeah, and we always talk about trade-offs on these example trades, and this is one of them. Yeah, you're only collecting about $1.30 on a $10 wide short neutral to bullish put vertical, but I think the key thing here is if you look at the probabilities of that 860 strike that you sold, it's about 84% probability that it's going to be out of the money at expiration in 20 days, which is what you want. And if you look at the Analyze tab, the break even on that's about 850, 870 to the downside. Joe, your thoughts here on this short out of the money put vertical, but giving yourself a great probability of success?
It's almost like Nick and I were trained at the same company many years back. I don't know how that works. Yeah, it's interesting because it like you said, it's one of those trade-offs, right? You're not collecting a ton in the credit, but you're giving yourself some of that downside cushion, if you will. And you're lining this up around the support levels. You got the 50-day moving average right there, just shy of 900. You got the 20-day moving average just around 876. So anything below that, he's got some cushion there where there could be some buyers that start to step in. And so no, I like the trade. Just got to be mindful of the fact the risk reward trade-off. On that, and Nick, you might call this the dumb trade, but I'm going to be looking at a dumb trade a little bit later on, just selling a call spread, because I think that when you're in this environment where you're range bound, which is I think probably where we're probably at the top end of the range for some of these names. Looking at these risk-defined trades where you know what you can get and what you have at risk makes a lot of sense. You don't have to make it very complicated. So. Well, you're doing a nice job with this one.
Yeah, I like that thought process because we always talk about the trade-offs on this show, and a lot of people will say, well, you're not collecting that much credit on a $10 wide short put vertical, but when you start looking at probabilities, you start looking at duration, only 20 days, and the fact that they report earnings on the 27th of April, so you're going to avoid that event risk also. But great example trade here to look at and to cover. As Nick mentioned, about $870 per spread in risk on that particular trade. Still risk defined, 20 days till expiration. All right, Nick Theodorakos, Managing Director of Financial Risk Management at TD Ameritrade. Thanks for joining us. Have a great weekend. But coming up after the break, Joe and I will be joined by Andy Swan from Likefolio for a discussion on Shopify. Fast Market will be right back in about 2 minutes.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watchlists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Fast Market on the TD Ameritrade Network. I'm Tom White, and I'm joined by my co-host for the day, Joe Mazzola. But let's bring in our next guest for our cash tag segment. That's going to be Andy Swan, the co-founder of Likefolio. So, Andy, welcome to the show. Hope you're going to be rooting for my Purdue Boilermakers later today. But right now, we're going to discuss Shopify. This stock's down about 50% so far this year. What kind of data are you guys seeing at Likefolio on this company? Because it's just been a falling knife lately.
Yeah, I'm going to be rooting for Purdue and Shopify. I'm starting to really like Shopify here for several reasons. The stock is way down, like you mentioned. May have gotten quite a bit ahead of itself last year, but in terms of the company itself and the growth that the company's seeing, and the way that it's dealing with its consumers and consumers around the world, really impressive. And for three reasons. First of all, we really see Shopify gaining on Amazon. In the fourth quarter of last year, the gross merchandise volume that Shopify did, in other words, how much product it's moving, reached to be half of that of Amazon, where 3 years ago it was just a quarter of Amazon. So they're really starting to catch up and penetrate into Amazon's dominance. A big reason for that is the innovation that the company puts together. We see this as probably the most innovative company in e-commerce. They're constantly working on ways for small businesses as well as large businesses to sell online, and especially powerfully direct to the consumer where the consumer is. So, empowering brands to sell their products directly through social media feeds and things like that. So really innovative company. And, like we're showing on this chart now, after a big drop last year, post-pandemic kind of hangover, we're starting to see a resumption in consumer demand for Shopify. And that means people starting businesses on Shopify. That means people, setting up their shop on the platform and buying products through Shopify's partners. So kind of a three-punch thing going on here that we really like. Shopify, especially with the price down at these levels. This is a stock that I'm constantly watching for. If it gets thrown out with the bathwater of the Nasdaq or growth stocks, I think this is one to be on your watch list to pick up.
Hey, Andy, I guess one of the biggest challenges that Shopify is going to have this year is its comps, right? Comps relative to 2021, given the fact that we're kind of moving out of this, well, we hope, right, that we're moving out of this post-pandemic world. How does a company like that make up for that 57% annual revenue growth that it saw last year, when analysts are now predicting that, hey, that's going to be a real tough bar to reach?
Yeah, it's one of those things you have to. It's one of those things that you kind of have to accept with high growth companies, is that eventually the numbers get so big that they're impossible to sustain. We saw that with Amazon's growth over the course of the couple decades, with Google. I think for long-term investors, you just have to say, the short term's going to be rocky. It's going to be volatile because this company does have incredibly difficult comps to match. But that could spell opportunity for long-term investors, because if this is the next Amazon, the next Google, and I think it's well on its way, then the returns that you could see 3, 5, 10 years down the road will make the near-term volatility much easier to digest. So, with that volatility comes opportunity, and that's kind of the only way I think that you can look at it, because I do think you're right. They have a rocky road ahead for the next 6 to 9 months.
Yeah, and we'll probably get some more clarity on the news that came out and sent the stock down this week, which was potentially getting some competition from Google Alphabet in this particular space, Andy. But on that scatter plot, that's what kind of interested me a little bit, where Amazon is down at about 70% positive mentions on a 30-day moving average. But you've got Shopify all the way up in the far right. You can tell it's not as big as Amazon, but at the same time, positive mentions recently over the last 30 days. When you look at that, is this a historical high as far as Shopify goes, and is Amazon's level pretty consistent?
Yeah, Amazon's level is consistent. I think that this chart speaks to the market share grab that Shopify is doing in this space, and Amazon as a primary target. And when we see companies kind of in that top right quadrant of that scatter plot, we get pretty excited about that, because it means that they're making their customers very, very happy compared to peers, and they're growing faster than peers in terms of consumer demand. That 1-2 punch, especially when the dot is that much smaller, meaning the company's that much smaller, shows considerable upside to us. And so we think Shopify is growing the right way. They're growing rapidly. And while they're growing rapidly, they're also keeping their customer base, their client base, extremely engaged and happy via the innovations that they provide.
Now, based on that, the positive sentiment data that you guys have on this, I know they don't have earnings for about a month now, but with that being said, I like what you said earlier about, if this thing does continue to pull back, then you look maybe for an entry point. So your sentiment's bullish, but are you bullish from these levels, or hoping that it gets back down to that 510 level that it hit just a few weeks ago?
Yeah, I mean, a lower price is always better when you're buying, but I am optimistic from here. We're seeing a reversal in Shopify's data on our side. It could be a little too early to say for sure that it's going to stick, but it is nice to see after that kind of 2021 pandemic hangover for the company to start seeing some real growth, and it's based on the innovations they're putting out to market. So I think that they'll have reason to be optimistic at the next earnings call. So I don't mind it even at these levels.
All right, great stuff as always, Andy. Enjoy the game today. Enjoy your weekend. Thanks for being here. Appreciate it.
All right, thank you.
All right, that's Andy Swan, the co-founder of Likefolio.com, joining us, giving us the sentiment data on Shopify. Joe, this stuff's pretty positive out of Likefolio as far as consumer sentiment. The positive mentions, the increase in mentions, that's. I look at that, and as far as their data goes, being that far in the far upper right-hand corner as far as positive sentiment data and number of mentions, pretty astronomical here, especially compared to maybe some of its competitors in the space. But you can't ignore the fact when Google comes out with maybe a blog post or a blurb that, hey, this is an area that we may look to get into.
Yeah, I'm going to throw my wet blanket trade on this one. I think that I think it ultimately, if you can get this one a little bit lower, it becomes a little bit more attractive to me. I mean, the hard part is, like I said, and the thing that is causing me kind of
got the trade up here, short call vertical, so neutral to 770 strike call, buying the 780, collecting roughly about $1.75 credit on that. Markets or bid-ask spreads are wide in there, so price discovery may be warranted if you'd like to do that. $825 in risk per spread that you sell. It is risk defined. You've got 20 days till expiration. But we'll key in on the probability numbers here, Joe, just like we did for Nick's trade. That short 770 strike that you've got has a probability of finishing out of the money at about 80%. So these are going back to those trade-offs that we talk about. Implied volatility is still elevated in Shopify, so you can still collect a decent amount of premium for something that has an 80% probability of finishing out of the money at expiration in just under 3 weeks on this particular position. And your break even on that one, on the example trade, is going to be a 771.75 to the upside, and the downside maxes out above 780 strike on this risk-defined short call spread that's neutral to bearish in nature. All right, great stuff on that example trade. But coming up after the break, we're going to take a look at Home Depot, which has fallen about 25% so far this year. Fast Market will be right back after this short break.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Ben Lichtenstein here with your TD Ameritrade Network Futures and Market Update. Let's begin with Bitcoin, higher on the day and holding near the Feb highs. This week, Russia's energy chief said they're now willing to accept Bitcoin for oil and gas. Treasury Secretary Janet Yellen said crypto has grown by leaps and bounds and is now playing a significant role in the investment decision of lots of Americans. She went on to say the Fed would like to create a regulatory environment in which healthy innovation can continue. Bitcoin futures bottomed out earlier this year in January around 32,000, currently up around 0.75%, just shy of 45,000. Rates are spiking into the end of the week. That took on a much more hawkish tone with Fed Chair Jerome Powell Monday suggesting a willingness to raise by 50 basis points if need be at the May meeting. The CME FedWatch tool shows a 72% chance of a 50 basis point hike at that next FOMC meeting. Treasury futures posted new multi-year lows today. The bonds traded down to 146.20, and that means rates are on the rise. The TYX to 2.64, the TNX, the 10-year to 2.5, and the FVX to 2.57, a reflection of the inflation concerns investors have been faced with and the murky waters the Fed will be forced to navigate in the coming weeks and months. This has been your TD Ameritrade Network Futures Market Update. Now back to Fast Market.
Welcome back to Fast Market. I'm your host, Tom White, along with my guest co-host, Joe Mazzola, joining me today. Joe, we're going to talk some Home Depot. We talked consumer discretionary earlier in the show, and this is right in the crosshairs of that. And the same thing that you mentioned on the last segment, as far as comps go, this is right in the wheelhouse of Home Depot, because the comps over the last 2 years have been pretty astronomical. So you'd expect a little slowdown. The company did guide lower on their last earnings event. Your thoughts here on what the market's telling you here in Home Depot?
Yeah, but there's a big difference in terms of the multiples here, right? I mean, you got a company that's trading 19, 20 times forward earnings, but they're growing 20% a year. So it's, and Home Depot's been able to really develop that better omni-channel network. It's got a fully loaded digital platform. It's recently opened up several more distribution centers and warehouses. It's improved its delivery capabilities. This is a company that, it was trading stock that was trading $420 at the beginning of January. Now it's pulled back down to $310, and I don't want to call it a value stock down here, but I think that you're getting a little bit more bang for your buck in terms of where this thing is traded relative to its 420 high, and at the same time, if you can get a 19 forward PE at about with the stock that's growing or the business that's growing 20%, then you're starting to see a little bit more value there. I think that at these levels it becomes a bit more attractive for a lot of people, and it's got some overhang, just like we've seen with some of the other names. I mean, it's going to have 340 seems like a level where you might see some technical resistance there. But if you can kind of construct a trade that gives you a little bit of upside.
Yeah, it's been a pretty spectacular pullback so far this week. It had a death cross just over a week ago, so the 50-day moved below the 200-day moving average. And this is one of those names, Joe, that's synonymous with people going to Walmart or Target, right? It's just consistently one of those stores that just remains solid. They've got a great balance sheet, a lot of cash on their balance sheet. They've raised their dividend over the last couple of years. They're repaying shareholders that way. And then the buybacks also. And, Joe, heading into their biggest season, which is spring, right? This is, we talked about it last night at home, that we've got to go out and get plants, and we've got to go get this and go get that. I mean, I've probably got 10 Home Depot trips planned for the next 30 days, unfortunately. But that being said, you mentioned the pullback that we've had. It just hit 52-week lows. But if you look at Home Depot over the last 3 years, it's still up over 61% from 3 year ago levels, even with that 25, 26% pullback that we've seen so far this year. You see the death cross that came in there on the chart, getting towards those 52-week lows. So, Joe, I wanted to look at this one from a trading perspective and short term. They don't have earnings until May, so we've got plenty of time for that to take place. But if you're going to look at this name and say your assumption is, hey, maybe it'll jump, I looked at a different strategy that we've covered today. We've covered way out of the money call and put verticals, both in Tesla and in Shopify. So I looked at something a little bit different, 4-leg spread, where it's going to be not an iron condor, but I'm going to look at a call condor on this name. And the strikes I'm going to go to, going out to the April monthly cycle, Joe, and that's basically 20 days till expiration. So you've got 3 weeks on this one for it to rebound. But I'll buy a slightly in the money call vertical, the 310, 317.5 call vertical, that's $7.50 wide. And then against that, selling the 325, 327.5. So only a $2.50 wide short, neutral to bearish call vertical. This creates a four-legged call condor. All the options are on the call side. You're playing for a move higher. The apex of profitability will be between your short strikes of 317.5 and 325 to the upside. But you've only got one. Yeah, you've only got one break even on this, Joe. And if you're paying roughly about a $3 debit on it, your break even is going to be 313 to the upside with no risk above that at expiration. Your thoughts on a call condor that you do this type of strategy, or you can do this type of strategy to kind of lower your input costs instead of just buying a vertical, Joe. Your thoughts on the call condor?
Yeah, I mean, it's a low risk strategy. It's a debit spread, basically, right? You got a debit spread and you're financing that with selling a credit spread against it. I think the important thing that you mentioned, Tom, and I think this is so important for all, new option traders to realize, you want to go to your short strikes in this, right? Like, you want to rally from your longs to your shorts. That's where this thing maximizes. If you look at the chart there, always look at the roof on the ceiling. People kind of talk about that, or the roof on the house. That's where this trade wants to go. It gives you the ability to kind of take advantage of the pullback. I mean, look, the stock's down another $5 today. So if you get a rally back above basically 313 and change, this trade is going to start doing fairly well fairly quickly. It's got some delta to it, right? And that's why it makes money as the stock starts to rally. Home Depot is at the mercy a little bit of some of the housing numbers that we've seen, but I think one of the things that Home Depot has, where it might be insulated a little bit more than the home builders themselves, is the fact that people like you, Tom, are getting the wheelbarrow out and getting ready for the spring do-it-yourself projects. And even though we're running out of the stimmy checks, right, nationwide, I think people savings levels are still a little bit higher than they were pre-pandemic. So there still is some of that money left for those at-home improvements. And if you need, give me a call. I'll roll up the sleeves. I'll go out there and help you with the mulch.
I definitely need some help, Joe. If I have to watch one more YouTube video on how to do something, I don't have enough time to do that. But